Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host Jordan Rochester from the Global Markets Research Team, and in this episode of our Fireside, we'll be talking Euben Paracuelles and our Chief Asian Economist, and Choon, our Asia FX Strategist, on their thoughts for Indonesia and also briefly the rest of the ASEAN region too. I'll be asking both of them, why has interest in Indonesia picked up more recently in the macro community? How does this compare to the rest of the Asian economies in terms of the outlook? And why Indonesia is perhaps the most sensitive in the space there to higher US yields, and of course, how to trade it. Now, Euben, let's start off with you. You've noticed recently that client interest in Indonesia seems to have picked up, just more conversations, more questions, much more than the usual levels that you've been used to over the last couple of weeks. So why is that? Why are folks so interested and what are they thinking here?
Thanks, Jordan. My sense from clients is that they are thinking and asking the question whether the IDR and government bonds have become cheap enough after the sell-off to start thinking about accumulating. And the common argument is, medium term, if you compare the metrics with other large EMs, Indonesia looks actually okay from debt levels or growth and inflation dynamics, and so people are thinking whether this is an opportunity to start going back in.
Well, you mentioned it's an opportunity. What is your answer then to that question? Is it an opportunity? Is this the time to invest in Indonesia, or is it just keep waiting, let the sell-off continue? What's the view?
From a macro perspective, I'm still relatively cautious. My view is that with still elevated external risks, I think the challenge for Indonesia is really to be able to fund a sustainable recovery. So in this context, I think we need to pay attention to domestic policy risks. What I mean by that is, debt monetization was a response that the authorities implemented in the aftermath of COVID last year, buying bonds, government bonds in the primary markets on a large scale. I think this year that's going to continue, but I think the problem there is this could be seen as an increase in debt monetization and could lead to concerns of runaway inflation at the time, especially when I think maybe BI might be needing to step up its purchases. Because one, the fiscal deficit is likely to widen this year in our estimate. And then two, as we've seen so far in the last 2 or 3 months, foreign participation in local government bond markets have been lackluster so far.
It does seem to me that now there is some divergence going on with all economies in terms of the fiscal deficits. So some countries are widening the deficits, the US just very recently with their package, and some are talking about tightening up their spending thanks to the vaccines and the reopening forecasts in the horizon. You mentioned there you think Indonesia's fiscal deficit will widen. What does that mean for the Bank of Indonesia? Are they going to do more QE?
Yes, I think that's going to be the main implication. If you look at our forecast, we actually think the fiscal deficit will go above 6% of GDP, even higher than last year, and relative to the budgeted 5.7% of GDP. That may not sound large compared to what we see in other countries, but in terms of nominal total gross financing needs, how that translates into, I think it's pretty substantial, which is why in the first place BI was providing all of that purchases on government bonds last year. I think it's going to be a replay this year. I think so far they've been able to implement them without much of concerns on the inflation side, because obviously inflation has been below target for a while. But our view is I think inflation is not going to stay that low for a sustained period. And this year, I think it's going to turn around, particularly in the second half of the year. And so I think there is a bit of a dilemma there in terms of BI's ability to continue to do bond purchases, but at the same time, stick to its inflation targeting framework.
Well, in one way, Bank Indonesia is doing the world a favor, because what we need is a case study for how MMT, modern monetary theory, plays out in reality. What we were lacking before this COVID-19 crisis was a case study, someone who'd actually done it in recent history, and how that impacts the markets, how that impacts their outlook. You mentioned inflation. MMT, one of the cons of this sort of process is it could lead to high levels of inflation. What's the view there for Indonesia?
Yeah, as I said before, I think the issue for Indonesia, going into debt monetization, they don't have a disinflationary problem that's persistent, right? In the last few months, inflation has been low, primarily because of the COVID shock, and therefore domestic demand has been fairly muted. But for an emerging market like Indonesia, I think the persistence of low inflation is not going to be sustainable. And indeed, what we're thinking that's going to drive inflation this year is a combination of things. We've got the base effects, which is quite well known, but then you've got supply side factors, excise tax changes, you've got ore prices going higher, and most importantly, I think the normalization of demand conditions, which I think could start to happen in the second half of the year, given the vaccination programs, given the reopening. I think that could start to lead to more inflationary pressures, especially because BI in its operations from QE last year has been injecting a lot of liquidity into the system, right? So that combination in our own econometric work suggests that this could lead to some inflation pressures 6 to 12 months down the road.
So, Euben, what about the external balance of Indonesia, particularly the trajectory of the current account? Is it going to, with this fiscal spending you're looking for, should we expect the current account deficit to widen this year?
Yeah, that's really the additional challenge here, Jordan. Last year, the current account balance swung into some periods of surpluses, again, because demand conditions were so depressed. I don't think that's going to stay in the same sort of surplus period for this year. I think, if anything, we could probably see a switch to a deficit, back to a deficit sometime in the second quarter. And so what it means is if you have a fiscal deficit widening, you've got a current account deficit also widening, your external financing needs also pick up, right? And again, obviously this is partly seasonal because the second quarter, on the work that we've done, there is quite a bit of dividend repatriation that's happening, some importation ahead of the holidays. But further out, I think the deficit will also persist, again, because importation could pick up as a result of economic reopening and domestic demand normalization.
We talk a lot about fiscal deficits. We talk about a lot about the current account deficits and financial flows. And financial flows definitely matter. There's one area of economics that actually gets me quite excited, which is reform, because reform can lead to years, not just a one-off cyclical swing thanks to a number, but could lead to years of improvement in growth aspects. Didn't Indonesia pass some reform, some sort of landmark structural reform? I can't remember when, maybe it was sometime late last year. And has that led to the outlook for foreign direct investment inflows to pick up too?
Yes, indeed. Indonesia passed an omnibus law on job creation, which, as you say, it's a landmark legislation involving labor market reform, involving ease of doing business reforms. And, it was quite impressive because they managed to pass it in the middle of a pandemic back in October last year. So there's quite a bit of hope pinned on this law in attracting significant amounts of FDI inflows. And indeed, as I would argue, again, because of the external financing needs that are large from the current account deficit, that has to be plugged by more sustainable, high quality type of inflows, i.e. FDI. So this is very, very crucial. But do I think that these FDI inflows will be large enough, at least this year, to be able to plug the gap? I think it's not likely. And the reason is the implementation of these types of reforms, as we keep seeing in Indonesia's recent history, it usually takes time. And therefore, the corresponding inflows also takes even longer. So that's why I don't believe that, even though this is a positive step in the right direction, in fact, a very big step in the right direction, I don't believe we would already see big FDI inflows as a result, particularly this year.
Was there anything else in that law that we should look out for? Was there any, I did read about a sovereign wealth fund being established. Has that made any difference to your outlook?
Yeah, correct. So the law also provided for the establishment of what they call a sovereign wealth fund. And I know clients are also quite excited about this. Locals think that this is a game changer. And yeah, it is quite innovative. This is the first time they're actually establishing this. But again, I would come back to the same argument that this is not going to lead to very significant FDI inflows in a very short time. If you look at where this was patterned from, this was after India's NIIF, right? So it's the same kind of setup where they try to attract foreign investment to fund infrastructure projects. And that's exactly what the government of Indonesia is trying to do. Unfortunately, the example of India does not bode well for good prospects of FDI inflows in a short run. They started the NIIF in 2015. As of today, the assets under management is only between $4 to $5 billion. So over a span of a number of years, it's still relatively small, and I suspect it's probably going to be the same case for Indonesia.
So I mentioned earlier that Bank Indonesia's a case study for all of us to learn from, this sort of how does MMT work. There's also the proactiveness of fiscal policy as well taking place as well at the same time. I did see that there's been some proposed legislation to change the Bank of Indonesia's mandate. And I did read in that as well that there was some chatter about it could potentially undermine its independence. That's a question that a lot of central banks have been asked this year in G10 as well, like the US and the Bank of England have also been asked about that, because there was times where fiscal and monetary policy was announced at the exact same time or very close to one another. In Indonesia, Euben, can you tell us more about the latest developments on that?
Yeah, sure. It's a very interesting topic for Indonesia, and one that is very closely followed by investors, especially in recent days. So what has happened was Parliament on March 9 approved the priority list of its legislative agenda for the year. So there's about 33 bills there, and it included what they call the Bill for Financial Sector Reforms. The idea is, they want to provide more powers to what they call the Financial System Stability Committee, which includes the central bank, to be able to respond during crisis period, provide liquidity assistance, et cetera, which I think is necessary. But I think the concern is, in addition to that, they are also looking to change the mandate of BI and add employment under its inflation targeting framework. Now that I think will already complicate Indonesia's monetary policy framework. And at the same time, they're going to add a few more provisions, things like more bond purchases by BI will be allowed. And then there might be some oversight committee that could supervise overall BI's operations. So, whether or not all of these things will pan out, it's something that we will all need to watch very closely. But again, just looking from the reaction so far of this approval of this priority list in Parliament, it seems like markets could become concerned about those issues on policy credibility, but also BI independence.
You mentioned market concerns. There's also the credit rating agencies as well. So I need to ask you about Indonesia's credit rating here. The S&P has Indonesia on the S&P had in the case since April last year. That's fair enough. It was during a COVID-19 crisis. Yeah. So it's actually been nearly been a year since that moment, Euben. What's next for the credit rating outlook?
Yeah, so despite all the policy risks that I've talked about, I think a downgrade this year by S&P is not necessarily imminent. And the reason I say that is, again, there are good things that have happened, including the structural reforms, and S&P will definitely look at that. In addition, I think they're much more focused on fiscal sustainability and whether the government can get back to the fiscal rule, which is to bring back the fiscal deficit to below 3% by 2023. At this point, it's hard to say what it is, but again, I'm trying to say that S&P might take time to make that assessment, and therefore that risk might be relatively low at this point. But of course, if it becomes clear that getting back to 3% might be difficult even this year, then I think that could be a potential risk and a trigger for a downgrade.
Now, Euben, it's time to get relative. It's always my favorite part because of my FX background. We need to put Indonesia into a regional context. I want to understand how does it stack up in terms of its pace of economic recovery from COVID-19 this year. Where is Indonesia in terms of the growth outlook for in the Asian region?
Yeah, it's not too bad. From our perspective, it is somewhere in the middle camp. So we have Singapore as our leader in the sense that this is the economy that will recover strongest and fastest this year. And then at the other end of the spectrum, we've got Thailand, which is obviously still very tourism dependent, and so it will take a while. And then the Philippines, because of the lack of fiscal stimulus, right? So both countries will be in our camp where they recover the weakest. Indonesia is somewhere in the middle camp in the sense that they grow at 5% this year, which is I guess in line with what the authorities are expecting or targeting, and in line with what generally markets are expecting.
Euben, this is kind of a personal question of mine. When will the borders open for tourism to Indonesia? That is something that, for anyone who wants to visit Bali, for me, for honeymoon, when will that happen? Because that surely plays a part of the outlook as well.
I think you'll have to be a bit more patient, Jordan. I think within the region, the vaccination program has happened, but it's the fastest in Singapore. Indonesia is kind of second, but it's a far second, right? So, and considering it's a large country, so many islands, archipelago, it's logistically very difficult to roll out the vaccination program. So I think it's going to be still along bilateral lines that they will allow and open borders, but to open it nationwide and to many different parts of the world, I think might take a little bit longer.
So we're talking more like next year at the earliest, I guess, by the sounds of it. You spoke about debt monetization risks as your key concern in Indonesia. Now, that is your key risk, your key concern for Indonesia, but do any other countries in the region share a similar issue, or perhaps not, but do they share this same inflation risks profile going ahead?
Yeah, so it's not quite the same in terms of debt monetization risk. I think it's really Indonesia and the region that has gone down that path since last year. But in terms of inflation risks, I think the other country to watch out for is the Philippines, because we've seen in the last 3 months, inflation has really surged and has exceeded the central bank's target. And it's going to stay that way for a number of months. Again, a lot of factors in there, supply side on food, but also oil prices is one of the largest oil importers in the region. So it definitely having an impact. And I think what's unique in the Philippines is even these supply side pressures tend to have second round effects that the central bank is worried about. So as a result, we are no longer expecting any rate cuts from the BSP. If anything, the risk is they could actually reverse course and maybe hike if inflation does not go down below target in the second half of this year.
Thank you, Euben. Well, Choon, we have to bring you in here and talk about the FX. The Indonesia view there from Euben is pretty clear. We should expect further debt monetization, a widening fiscal deficit. I mentioned earlier how Indonesia provides us a useful case study for how these policies will work out in real time and what we can learn from that. One of the sort of points of MMT is I would have imagined folks to have expected a weaker currency. What's the strategy team's view on IDR going forward, Choon?
Well, that's a very good question. So IDR, in fact, has been enjoying some kind of a sweet spot because its basic, rather balance of payment position has actually been supported by the current account turning into a slight surplus since the Q3 due to COVID-related distortion, and also because the net FDI has been relatively strong. So that has been supported the IDR. However, going forward, we do see quite a bit of a vulnerability against the IDR, and we expect the IDR to kind of underperform against the dollar and also against the regional currencies. So first of all, one of the reasons is because we see the IDR as the Southeast Asia one of the most sensitive currency to higher dollar yields. So especially if the move higher in dollar yields becomes more disorderly. So we just had the March FOMC. It was actually perceived to be dovish and helped to calm the market sentiment somewhat. Nonetheless, we are still quite cautious we are cautious that the positive market action that we saw right after the FOMC of lower yield, softer dollar, and also tighter credit spread can actually sustain without more significant action coming from the Fed. And we think that the Fed will most likely only act if the overall financial condition tightens significantly. Therefore, from this perspective, we think that the idea should continue to face quite a bit of near-term pressure from rising US yields. So this is one reason why we think that the idea could actually be negative in the near term.
High sensitivity to US yields right now, with US yields moving the way they are, must be pretty tough trading environment. So beyond that, beyond the US yield sensitivity, is there anything else we should consider for IDR?
Well, I mean, there are a few. So in the near term, I think our seasonality analysis shows that the idea could actually underperform going into the second quarter of this year. So we are very close. So this underperformance is especially pronounced in the month of May due to portfolio outflows that we tend to see, and also because of foreigner repatriation of dividend payments onshore, and also repatriation of income interest. So beyond seasonality, we are also concerned over the Indonesia's FX reserve. So Indonesia is the only country within Asia that has persistently struggled to accumulate FX reserve. So just for example, the government actually issued around $12 billion of global bonds over the past 12 months. However, the FX reserve headline number only have risen by perhaps close to $5 billion over the past 12 months. Therefore, the BI's reserve adequacy ratio has actually remained quite low as compared to the rest of the region. So, for example, India's reserve adequacy ratio is actually at a very high, at about 320%. So, as compared to IDR, or rather as compared to India, IDR, Indonesia's FX reserve level is actually quite low. So what it means is that the BI will likely try to accumulate FX reserve when the market conditions are right. So thereby, it will limit how much IDR can appreciate if the broad dollar starts to weaken again. This low reserve adequacy number also means less room for BI to actually conduct dollar selling intervention if there is market stress.
Well, it's important, Choon, to always compare the financial flows to the trade flows and the sort of current account flows as well. So we're talking about current account widening, the deficit getting wider thanks to fiscal stimulus, thanks to the government's plans that Euben outlined. We talked a bit about financial flows with the FDI. What about the other sort of flows that feature in the financial, that tug of war, that sort of trade flows versus financial flows, the balance of payments? What can we say about that for Indonesia?
I think a key to note is that with the economy slowly opening up, the import of Indonesia is actually normalizing. So what this means is that the slight current account surplus that Indonesia has enjoyed since the Q3 of this year will become a deficit again, most probably from the Q2 of this year onwards. So this will become a significant drag on the IDR again. So this issue will become more critical as we move into the second half of 2021 because US yield is likely to continue rising with rising expectation of the Fed tapering coming in from the second half of this year. So when foreign bonds flow into Indonesia actually stops or reverse, financing the current account deficit that is actually widening out will become more of a problem for the IDR going forward. So this is something that we need to watch.
What other views do you have for Southeast Asia currency space?
So the Philippines still enjoy a very favorable current account dynamics from the narrowing of its trade deficit, and also because of some recovery in terms of their overseas worker remittances, and also because the business process outsourcing sector is actually doing pretty well. So there is actually currency inflow coming out from those angle, helping to support the peso. So on the other hand, we think that the Thailand's current account could actually continue to suffer. In fact, it has fallen into a deficit since the November of last year, really because of a narrowing trade surplus and also because of the lack of tourism inflows. and this is really not expected to recover anytime soon. In Thailand, the foreign portfolio inflows also remain largely absent this year, with concern over the strict protests and also because of the ongoing weakness in the economic recovery. However, there's something to watch out for. So we believe that the Thailand is actually at risk of being labor FX manipulator by the US Treasury in the upcoming April 2021 FX report. So market expectation is that BOT could then allow for FX appreciation, meaning stepping back from aggressive intervention in the market. And therefore, this is a risk to our relative value trade, and we actually plan to reassess this position as we move closer to the date of the FXR report release date. So that is sometime around the middle of April.
Well, thank you, Euben, and thank you, Choon. That's a wrap. Thank you for joining the podcast.
Thank you.
Thank you.
And that's the Fireside with Euben and Choon. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one, and please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.